following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the number one listened to financial show in Dallas. Okay, that was like 4 months ago, last time I checked. But I'm still sure it holds true now.
It's been that way for a while now.
I know.
Hasn't it?
Absolutely.
Absolutely.
It always has been and always will
And
be.
Dallas is a large market.
That's right.
Come on, man.
I'm Victor McClure. Remember, I'm your host, the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing?
Hey.
We haven't floated away. This is one thing. I live in Prosper, and it's supposedly the highest point in Collin County. My wife was afraid of flooding. I said, if this house floods, trust me, all of Frisco, McKinney is underwater.
Yeah.
All of it's underwater. I go, but then I bought some other houses for my in-laws. You might have heard about that lately. They're all flooded. Every one of them. I'm like, not only am I buying houses I'm not going to get rent on, now they're flooded and I got to fix a million things.
Apparently Houston's had a heck of a hard time down there.
That's already a lot closer to the what do you call it, the ocean level or whatever.
Sea level. Yeah, it's like,
yeah.
it's why they bury the bodies above ground in Louisiana, right?
Yeah.
They got to.
Have you ever noticed
New
that?
Orleans.
Have you ever, you're driven down to Houston, we're like 400 to 700 feet above sea level, something crazy.
Right.
Do you realize you're going up that much as you're coming to Dallas?
No.
You'll never notice it, right?
No.
It's just a slow grind. Remember, folks, we made this show to answer your financial questions. We try to do it in plain spoken language. We're not going to give you a bunch of Greek letters and tell you, look at the alpha of this particular fund versus that particular fund. We're not going to give you a lot of BS, private investments like private real estate investment trusts or life settlements or any of that other garbage. Because like we've said so many years, any financial advisor that even offers that kind of thing is suspect in my mind. Doesn't mean they're not legitimate or trying to do the right thing. I just know on my 30 years experience doing this and Guy's 30 years experience, they don't work out 90% of the time.
The problem right now is with the low interest rate environment that it seems like we've been in forever, right? They get really attractive. One thing nice about REITs, private or otherwise, is they usually pay what? 7.5% a year.
Right.
But try to get your money back out. It's got to go public. You've got to create a market. There's a whole lot of things, and it's tough.
Even if it's completely legitimate, there's so many reasons, or not reasons, but the urge for the management to charge you double next year.
Conflicts of interest.
Triple next year. And there's no law against it.
It's disclosed in the prospectus.
So there's nothing wrong with a real estate investment trust.
No.
Just stick with the ones that are already registered, not registered through an exemption, but registered, on the market, liquid. Those things haven't done too bad. Don't put all your money in real estate. I know all the real estate shows say it's the only thing to build wealth, all the best people. I get all that.
What we're saying is don't put all your money in any one thing, right?
But if you put all your money in real estate, I've been around here long enough to see real estate go up, real estate go down. What happens when it goes up? They build everything. Apartment buildings going up everywhere. Then all of a sudden, they built too much. Thing crashes. Now you got vacancies everywhere. So right now, I think rental property is probably one of the best income producers you can get right now. It just won't always be like that because they always overdo everything. Think about these hospitals. What's that, Forest something in Frisco?
Right.
One of the nicest hospitals you ever find. Went out of business now, about taken over by another one. You go to hospitals now and try to see a wait in a waiting room, except Parkland, with there's no insurance people. But you go any of these places, there's no wait. They've got all those standalone emergency rooms and, minute clinics and all that kind of stuff. You can walk in any time, get stitches or anything. There's no wait. So there's a difference. They built too many of them.
Speaking of that, and digress a little bit, did you see on the news this last week that United Healthcare is pulling out of the Obamacare? For a while, the taxpayers supported the difference in the negatives, right? And now that's no longer there, they're not going to do that anymore.
Are they the biggest? They might be the biggest or second biggest.
Yeah, they're right there.
Yeah, it's not going to help the situation. Like I said, there's always unintended consequences of everything. Obamacare was trying to get that last, 10% of people insured. The unintended consequence is it made 90% pay more.
That's right.
Made insurance companies lose their butt, and now we're all going to pay for it. That's just the way it is. So let's get off of politics for a second. Anyway.
Oh, you can't get away from it right now. It's everywhere.
I can't even, I'm a big news guy, political guy. I can't even watch the news anymore. It frustrates me so much. So.
And we've got 4 wonderful candidates to choose from, don't we? Just pick one. They all come with a lot of baggage.
All right, let's talk about orders to save money. I'm going to talk about the order on how you withdraw money once you retire, but the order that you save money when you're in the accumulation phase. Remember, we've talked about this before. There are 2 phases in your financial life, the accumulation of assets and the distribution of assets.
And they're different.
They're completely different. You could be the greatest accumulator in the world. You laugh at Warren Buffett. You just, what a joke he is. I can make much more. All that could be true. You mess up one time in the distribution phase, it can all be over. And so that's why, and if you have the same investments in the distribution phase, because what happens is, that I can't hardly say it, familiarity.
Breeds
bias,
contempt.
Right.
Yeah.
You've got that bias. And so you're going to stick with things you know. This happens all the time. Even though every book in the world says you shouldn't be 100% stocks, I'm talking about you can't find a book that doesn't hardly, right? It doesn't matter. You're familiar with it. It's got you this far, so you're going to stick with it. But there's a reason for that familiarity. I can't even say familiarity today.
You got it.
That bias can get you in trouble because you're in a different phase of your life. The mathematics of investing or the mathematics of a loss while you're taking income from your money, it's a death spiral you can't get out of.
Well, and like you say about the familiarity, it's difficult. Change is tough. I mean, you got to do things different. You may be getting into something that you're not familiar with. Yep. You've got to learn. That's right. And as we get older, it's harder to learn. I'm telling you.
I'd rather stay with what I know.
You think it'd be easier because we've learned how to learn, but it's not. Your learning curve now is vertical instead of nice and flat on the things that you know. So we understand it's difficult, but it's worth the transition and the effort to do things proper.
I'll give you one example of the difference between accumulation and distribution phase. Let's say you like stocks, and you've always made at least 5% a year. Let's say you like dividend stocks, whatever it is, 5% a year. In 2008, they dropped 40, 50% just like the regular stocks did, right? So let's say you got this $1 million, and your plan is, I'm always going to take 50 grand a year because I've always made at least that.
Right.
So I'll always keep my $1 million intact and take 50 grand, live off the dividends.
Still have my $1 million.
Yeah, tax preferential, all that kind of stuff. But what happens if it does go down 50% and you're taking money out? Okay, think about this, folks. You got $1 million, you took 50 out, you got 9, it just lost half. You got 400-something thousand left. If the market stays even the next year, you still need this 50,000 to live on. It is a death spiral you can't get out of. You can't buy and hold your way through it either. Because even if you buy and hold your way, market makes 20%. You only got 400, right? You're taking out, that's only 80 is 20%. You're taking out 50, so you're only gaining 30 on that. When the market makes 20%, you're only gaining 30, right? So that's where the problem is. It is a death spiral you cannot get out of. You have to change gears when you start getting towards retirement. It's not the day you retire. I have this happen all the time too. People come to me, yep, I know I'm going to do that, and the day I retire, I'm going to do that. You have to plan a few years before that if you're going to be smart about it.
Or we'll have people come in and say, all right, Victor, all right, Guy, here's my stuff, and they've saved, and they've done a good job. I'm going to retire in 90 days. Yeah. Go. It's
right.
Like, oh.
If they had done a planning just a couple years earlier, and that's why we tell you it's so important. Get a retirement plan in place. If you're within 10 years to retirement, have a written retirement plan. That's what we offer, a written retirement plan, no cost, no obligation, and you adjust that plan as situations dictate, as you get older. Because normally the plan is, this is going to be the plan. Here's my income. Here's how much I'm saving, all that stuff. But, things happen. You lose your job. You might get a raise on the good side, right? There's all kinds of things. Or you have your niece has to go to college and your brother and sister-in-law can't pay for it, so you're going to help them out. All of those things come into play. So you have to adjust this plan as you go.
And what Victor's talking about, from the accumulation phase to the distribution phase, and we talk about it a lot. You'll see it on our website, ilovemyretirement.com. What we want you to do, what we want to help you do, is avoid the irreversible mistakes. If the market goes down 30 or 40 and you're withdrawing and you're all in the market, it's almost irreversible. There's things you can do to avoid the irreversible mistakes.
Yeah, remember our philosophy. One of the ways we avoid the irreversible mistakes, we're going to go over the orders to save and orders to withdraw money after the break, but one of the reasons we go over that stuff is how to prevent some of those irreversible mistakes. If you've got $5,000 a month in bills, get $5,000 a month coming in. How about 6? That way, no matter what happens to the stock market, no matter what happens to interest rates, your bills are always paid. Another plan that's good, have that coming in monthly, not quarterly or annually. Why? Because your bills come in monthly. And so that's what you want to do every single month. That's why I call the website ilovemyretirement.com. If you want to worry about what stocks are going to do, what's happening geopolitically in the world, what's happening to who the president's going to cause your retirement account to go down, whatever, that's your business. I want to love my retirement, and what that means is I'm getting more coming in every month no matter what happens to anything. Stay with us, folks. Remember, if you have any financial questions or like to take advantage of our no obligation, no cost retirement plan and Social Security Optimizer, call our hotline 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, our website, if you'd like to see some videos, all that kind of stuff, there's a lot of good information on there, plus some educational information that changes about once a month. It's ilovemyretirement.com. Why do we have ilovemyretirement.com? We say we love our retirement because we know our clients' bills are paid. They know they're paid. Does that mean we don't like the stock market? No, we love the stock market because long term, it's the only thing that's been proven to beat the inflation. But that's only after the bills are paid.
And again, common sense investing, back to the theme of the show. If you think about it, if you need $5,000 or you need $8,000 a month to cover your bills, and you've got that $5,000 or you've got that $8,000 a month coming in, what could possibly mess that up? Short of 10% inflation, where all of a sudden that doesn't become enough, and that's a real far stretch, or a apocalyptic world, you're in good shape.
Oh, I have people, especially remember Y2K,
Oh, yeah.
But over the years, I've had so many people call me and say, well, I just think it's all the whole financial system is going to collapse, so I don't know what to do. I'm going to get out of the, no matter what you do, everything you own is valued in dollars, right? If it takes a wheelbarrow of dollars to buy a loaf of bread, we're all screwed. So,
and if you got
what does it matter? Don't think about apocalyptic things. You can only plan for logical, reasonable, things. You can't plan for those because, trust me, if we become a third world country, it's not going to matter anyway.
And think about it also, again, back to common sense. I mean, gold is great. If you have 5 or 10% of your portfolio in gold, that's probably a fine thing, some sort of hedge, right, for you. But if we get to that situation where the financial system collapses and there's nothing of, who's going to take a 1-pound bar of gold for anything?
The most precious metal, if that apocalypse happens, you've heard me say it, is lead.
That's right.
I would rather have lead.
Absolutely. It's easier to carry.
Oh, that's right. I remember all these people, the Y2K. I've got a whole thing buried. I'm off the grid. I've got blah, blah, blah. I'm telling you, if this apocalypse happens, the horde is going to come out of Dallas.
They're going to see your lights.
That's right. The lights are on.
They're headed your way.
All we got to do is kill that guy, and we got a place to live.
And some food for a while.
You better have a hell of a lot of lead, right?
That's right.
All right. Here's the order to save money. Heard this before. Always save money first in retirement plans. I've got people come to me, 65 years old, have $3 million in retirement accounts. I have them come to me, 65 years old, and they have $20,000 in retirement accounts. 100,000, 200,000. What's the difference in these people? One started early, a lot earlier. And they also had other things like big matches. Some of the companies used to match pretty good.
Oh, yeah, absolutely.
They put profit sharing in their 401k.
Stock plans, all sorts of things.
And so if you have one of those deals.
So you're saying that's better than like a life insurance policy?
That's better, way better. Make sure you save in those retirement plans. I've heard advisors telling them not to put in even the company match portion.
I know.
I'm like, that's free money. That is the dumbest thing I've ever heard.
Part of your package.
That's right. Not only should you put in the match, but you should put in as much as you possibly can. Because remember, this is tax deductible money.
I tell people
deferred.
I tell people to the point of pain because it takes a lifestyle adjustment to get those big numbers, especially if you have kids. And and college and all that stuff. You got a lot of places for your money all the time. Everyone's coming after it.
Oh, yeah.
So it's painful, but you got to adjust your style of living to do it. If you do it when you're young, makes life really sweet as you get older.
Just think about it. You save $1 million, all you can get is 30, 40,000 a year from it. Maybe 50 if you're doing an annuity or something, 60. That's not a lot. So you're going to have to put a lot. Think about it. If you're only putting in $100 a month into a 401k, that's $1,200 a year. Let's say you got 20 years to retirement. That's still no money. You're not going to be able to live on that. Trust me. So the quickest way to save. Now, if you got matches and all that other stuff, that's even better. But even without a match, even though your company 401k sucks, doesn't matter. It's still the tax deductible nature of it and everything else makes it almost impossible to save quicker than a 401k.
And in theory, there's different situations and exceptions, certainly, but you're taking money out of a time in your life when you're paying a higher percentage of taxes and deferring it to hopefully a time when you're paying a smaller percent. Right. If you take it, 4% a year when you're 70.5 and you get into the required minimum distribution. So again, you're taking it from a higher tax bracket and hopefully shuffling it back to a lower tax bracket.
Don't believe anybody tells you a Roth IRA is better for most people, because mathematically it's actually a regular IRA or 401k is better. Unless you're one of those people that are fortunate enough to be in the highest tax bracket possible now, and you're no way going to not be the highest then. But you have to have many tens of millions of dollars to be in the highest tax bracket when you retire.
But like tax-free bonds, people love Roth IRAs over anything else because I don't have to pay taxes on it anymore.
But that is my next place to save money.
There
401k, if you are in the income guidelines, I think it's $200,000 a year.
Right.
You can still do a Roth on top of that. So that's not bad. Then you save cash, things are called non-qualified. And so that's kind of the order of saving. Now, you can do other investment products, especially ones that do you like, all right, you need to put in $500 a month into this thing. But remember, you've already maxed out your other stuff. Don't do them in lieu of. I see a lot of these life insurance guys saying, no, don't do that 401k money. Put it in my life insurance policy. No.
You'll get it back tax-free.
And I'm not telling you they're the greatest deals because some of them are ridiculously expensive. But if it's a forced deal psychologically where I'm putting $500 a month in that, I'm putting $1,000 a month in the 401k, I got another $200-300 a month going in the Roth, those kind of psychologically where they're just like bills to you and they get paid. If you'll do that, especially from a young age, you'll end up with all the chips. The people that I have, most of my clients, a lot of them are doctors and engineers. And I'd say more than half the time, the engineers end up with more money, even though they didn't make as much.
That's true.
And why is that? Because they're plotters. They knew the value of saving from an early age. And we'll go over more of your questions, and we got questions today, and we got several more topics. So stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you have any financial questions or you'd like to take advantage of our complimentary, no-obligation written retirement plan and stress test and our Social Security Optimizer, don't hesitate to call our hotline at 972-715-2424. Remember, you've got to have something written down that shows you what potential inflation can do to your expenses and what a potential not making that much on your portfolio is. It mean if I don't make much in the market, am I going to be eating cat food when I'm 80? You have to have that in writing. So don't hesitate. We would love to do it. 972-715-2424.
Also,
ilovemyretirement.com.
Yeah, I was just going to say, visit the website. ilovemyretirement.com. There's some videos on there. There's past shows that are archived. There's some calculators and some helpful tools for you as well.
Even after you've listened to this show today, if you want to listen to it again.
And I wouldn't blame you.
I don't know if we have any listeners do that, do we?
I don't know.
I do have them call me when one didn't put up in time. Hey, that one's not done there on Monday. I'm like, okay.
We usually get 1 or 2 hate calls, don't we? You can't avoid those.
Over 20 years, every once in a while, you'll get one.
Oh, yeah.
I hate your verse. I want you to die. I'm like, hey, calm down there. Why don't we have institutionalization anymore? All right. This is the order. We talked about the order to save money. Now here's the order to how to withdraw money when you're in that distribution phase. It's the opposite of saving money, okay? Because normally the first thing you did, retirement accounts, right? Last thing you did was after-tax money is what you saved. If you want to save it the most efficient way, the most mathematically purest way. In other words,
Right.
get the most money. But how to withdraw money is just the opposite. When you withdraw money first, you want to take your non-qualified or non-IRA, non-retirement money, take that first. Why? Well, you've already paid tax on it. And so you can take out a lot less to live on. And you can continue to defer those retirement accounts so you wouldn't have to pay tax for many more years. And you can delay that to when they make you start taking, maybe 70. So you retire at 65, you might can delay it by using non-qualified funds, but don't get them too low. Got to have your reserves.
And we use this to help design portfolios for our friends. You know, your IRA or your 401k, which becomes an IRA essentially when you separate service from your job, is really a forced income stream anyway. It's 70.5. You required minimum distributions. You start out at about 4%, and it increases every year because they want their taxes. So when we build a portfolio and design it, a lot of times, if it comes together just right, we can use the qualified money to put part of it into these fixed annuities where they guarantee you 6 or 7% a year or some really good return while you defer it for income. And then you take the non-qualified money and you can live off of that to bridge the gap so that you can get to 70 and you've got a bigger sum, and then that kicks in at 70. Your Social Security kicks in at 66 or 68 whenever you start taking it. And the plan dovetails nicely. You'll know exactly what you're going to get at each particular point. And if, everything is fluid. If you need to make changes, you want to retire earlier, you can wait later. It's all adjustable. So just to give you some ideas, there's some neat things you can do.
We can adjust the order of withdrawal in all of our different accounts as well.
Sure.
It's also going to factor in the required minimum distributions you have to take. Because some people have a 401k they don't ever want income from.
That's right.
So you got to factor in the RMDs the government's going to make you take. And remember, you have a big IRA, it is really tough to maintain that thing over your lifespan because the government's going to make you start spending 10, 15% a year of it and when you get older. And so you're not going to be able to make enough in the market or whatever to make up for those things. So you'll only have what's left after taxes. And remember, the more you take out of retirement accounts, the bigger your tax bill is because it's higher tax bracket for you. And so you got to think about all of those different things. So your retirement money would be the last thing. Now, I understand a lot of people, 99% of their money is retirement money, so you have to adjust that plan where you have to start taking that out immediately. And so you got to also think about things, well, do you want a little more the first 10, 15 years of retirement? Some people might say, well, I think we're going to do our traveling, 65 to 75, maybe 80. I just can't see me, walking through India when I'm 85. Well, that's something you need to address then. And that's what a written retirement plan will do.
That's right.
We'll address all of those different issues because you're right. Inflation will eat into your stuff, but also you probably are traveling your first 10, 15 years in retirement more. And for those of you who retire early, this planning is even more crucial. Even though I get people that retire early all the time, for some reason they think it's not as crucial when it's more crucial to them. Somebody comes to me at 80 years old and they're taking out a little larger than normal withdrawal out of their life expectancy is not as long. They can make more mistakes and still be fine. But a 55-year-old retiring, you make a mistake, you're going back to work if you want to maintain the same lifestyle. There's things that you can do to prevent all of that, but you got to be open to it because the younger we are, the more bulletproof. It's just like remember when I was a kid, I would go, rat racing in my car like an idiot. I could have killed somebody. But that's what you did because you were bulletproof. Now I would not even consider that. We used to lift up rocks looking for snakes at the lake. Real smart, right?
I used a stick or something at the creek. I didn't just
wouldn't even do it now. I remember jumping in for a snapping turtle in the pond. I'm like, oh, look at that. Grabbed it. I'm like, I wouldn't get near that thing now.
Vic, we were talking earlier about a family member of yours that's in the same business.
Oh, we got a break. Come on. Let's do that story when you get back.
We'll tell the story later.
Remember, if you got any financial questions, don't hesitate to call us at 972-715-2424 or go to ILoveMyRetirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. And that's, when I developed this show a long time ago, that's exactly what I thought. It's got to be common sense. I don't want anything I'm saying for someone to be able to argue with going, that's ridiculous.
Or not able to understand.
Yeah. Anything we say, if you really think about it, put your biases away, whatever, it makes sense. You were about to start a story before we had a break there.
Well, we were talking about emotions and a few things. We go through a lot of effort, and you design these portfolios, and you use some non-qualified money to bridge the gap until you can get to your qualified money. And we use fixed annuities to do it. It's a great tool for guaranteeing. It's not where you put your whole portfolio, but it's really good for the income, and an absolute, what your number is going to be. But man, you can have 15 or 20 positives, right, about why it should be done and the absolute number and what age it is and the 6% growth, and you take the up years and not the down, all that great stuff. But somebody comes along and plants one seed. Oh, I can't do that.
Oh, yeah. That's it. You've got to fight emotion when it comes to. Now, you don't have to use a fixed annuity. You can use a bond.
That's right.
It just takes a lot less money if you use a fixed annuity. Because you can use any kind of fixed income instrument. You can use CDs. It's just going to take about 5 times more money. And so that's the only reason we're using, in today's environment, a fixed annuity makes more sense. But it's just because interest rates are where they are and all that stuff. 10 years from now, it might be we might be putting something else in that plan. But that goes to your point. There is a psychology of investing and your money. And I'll give you an example. One of my relatives, I'm not going to say who, works for a wirehouse, and they were in something called the conservation department. Conservation department is if count is about to leave, you go try to conserve it.
Right. Save it.
And I said, well, how do you deal with this? I've been taking money out of y'all's coffers for a long time. And he goes, well, it's pretty easy, really, because the way people are. I go, what do you mean? He goes, you can have 10 written reasons why they should do something. All I need to do is give one little sliver of doubt. I go, well, how do you do that? You don't even know the product. And they go, oh, we don't have to. All I got to say is, oh, my gosh, who did that to you? Oh, can you still get out of that? Oh, well, what's wrong with it? Oh, we heard bad things. That's all it takes, folks.
Yeah.
10 written reasons that make all the sense in the world. All you got to hear is, I heard. Now, I said, you guys have never done this product. Never done. He goes, that's right. So we're not saying it. We just said, well, we heard bad things.
Yep.
That's all you got to do. So you got to fight with your emotions. Use evidence. If it can't be used in a court of law, throw it away. It's rhetoric. Don't believe it. Now, if it can, you do have to weigh that because there are pros and cons with every strategy you'll ever look at. And so if you come with pros and cons of every strategy and look at the actual pros, not somebody, I heard this, what, that. I did this.
That's
I had another one tell me, we don't make money on those particular things. I go, oh, really? I didn't realize that one of the biggest firms in Dallas, I'm not going to say the name, is somehow a nonprofit now. Because I know the wholesalers that sell them to everyone, and every single person makes a commission. But your particular one did not make a commission. Or they turn it into an annual commission instead of so they call it a fee. So they were technically not taking a commission, they were taking a fee. But anybody tells you they're not compensated for working with you or giving you advice or being your advisor, I immediately discount everything they say from that day forward because either they don't know what they're talking about or they're trying to mislead you somehow. Everybody gets paid. I get paid. Even if you don't pay a commission, I'm going to get paid something. Even though I love people and I'm a charitable person. If anybody knows me, they know I've taken care of 100 people. But I'm not doing anything for free. If I'm working here 10 hours a day.
Well, no, that's not true either. We do a lot of things for free, helping folks. But
actually, I'd say about half the people that see us.
Yes.
We do their work for free.
Yep.
Because sometimes we can't work with them one way or the other.
Yep.
But we send them along with that still written retirement plan, all that stuff. We'll help anybody. We'll put them send them in the right direction, even if we can't work with them. But you know what I'm saying? When it does work, I do get compensated.
Absolutely.
And everybody does. Remember, if anybody tells you they don't, no, I don't give me a break.
Right. If you can, the takeaway is if you can remove the emotion from the decision-making process. Same thing if you're buying a house and all of those things. If you take the emotion out and look at it, common sense, logically, you'll come to a good decision.
Right. Think about it. Here's a good example of how emotions mess things up. Let's say you're in a stock. I'm just going to make it up. AT&T stock, whatever. And it's gone up a whole lot lately. Well, you should diversify because you put 100% of your money in one stock. But why would you do that? I made 20% last year. That's crazy. There's no way I'm not going to get out of that. So you're kind of locked in, right?
Right.
Then it goes down. You're like, well, as soon as it goes back up, I'm going to sell it then. Then it keeps going down. Well, I surely can't sell it now. It's lost half my money.
Let's take it a step. Let's do it a little harder. Take a step. Let's say you're in 2 stocks. You're in IBM and AT&T. AT&T has gone up 50% in the year, and IBM stayed flat. Well, now your portfolio is out of balance, right?
That's
You've
right.
got way too
And
much.
you should do it.
You should sell the winner
That's right.
and buy some of the losers so you
Right.
balance your portfolio.
That's right. You can't
It's
do it.
hard to do.
You can't do it. That's why you've got to take emotion out. We're talking about dollar cost averaging,
Right.
every other thing you can think of, putting money in 401k, even change your lifestyle a little bit to put more in the 401k. People don't want to do it. It's psychological. And they also, especially when you're young. Remember, Guy, when we were young, somebody
Yes.
our age we thought was the oldest thing you'd ever seen.
Oh,
Every time they said something, we're like, yeah, whatever, Grandpa. Now we're the grandpa.
I know.
And we're doing the same thing they did. You young punks don't know anything. Why are you speeding across? There's kids in this neighborhood.
If you have any questions, I love myretirement.com. It's got a lot of things on there that you can do. We've helped a lot of people, as Victor said, come early in planning for retirement. So you also want to kind of posture your 401k and get it ready too. So whether it's selections, in-service withdrawal, there's all sorts of options. We just want you to be aware of your options.
Yeah, and we talk about retirement a lot, just like every single firm out there, every radio show. Doesn't matter. We help people of all ages. It's because 90% of the people need the most help at that point. And so that's why you hear everybody talking about it.
You got the most money too. If you make a mistake,
right.
then it can be irreversible.
That's right. All right, folks, we got a break coming up. Stay with us. Remember, if you have any financial questions, like to take advantage of our no cost, no obligation retirement plan, stress test, and Social Security Optimizer, call our number 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome to the show. All right, here's a segment where I vent a little bit.
Uh-oh.
Recent study it's from the IRS, actually. 45% of Americans do pay zero taxes, no federal income tax. About 50% pay, I think it's $1,000, $2,000 or less in total income tax. Okay.
Wow.
The reason why I'm venting here is I'm so tired of people that don't pay any taxes telling everybody else they should pay their fair share.
Bernie Sanders. Oh, did I say that out loud?
Here's an example. If you're a couple and you make $75,000 a year, it's actually $74,950, something like that.
Yep.
$75,000 a year. You realize you pay 90% of the taxes already for the entire world, not entire United States. 90% of the taxes. Now, let me ask you this: if you and your wife together are making $75,000 a year, do you feel rich?
Oh yeah.
You feel
Champagne
like the money's
and caviar,
flying out of there.
baby. Oh, yeah.
$100 bills flying out. You're giving the money sign like Johnny Manziel. You're doing all of it, right? Nah, of course you don't. Remember, Bernie Sanders had the deal: if you make $140,000, we're only going to raise your taxes $44,000
a year. Oh.
If you look at a chart on there when you got your standard deductions, if you got a mortgage and all that, you're probably paying $20,000 now. So he just tripled your taxes, and that's the only fair way to go. That makes me so sad. I'm like, wait a minute. We're already paying 90% of the taxes. 90%. Yet we're not paying our fair share, and some yahoo that's not paying anything thinks I need to pay more so they can forgive their student loans and all this other crap.
Well, you know, what gets me, the people that aren't paying the taxes think that the people that are out there earning and who are paying 90% of the taxes
they're rich.
Aren't paying enough. They've got too much money, and they need to pay more.
Right.
It makes no sense.
I mean, what they're doing is attacking the billionaire class and all that. But if you look at the billionaires percentage-wise, they don't pay the kind of taxes as regular working folks.
That's true.
And so, but
we talked about this before, to interrupt you on purpose.
Sure.
If you confiscated,
That's right.
everything they owned.
That's right.
It wouldn't be enough to
tax 100% for everybody who makes more than $1 million. You still wouldn't be enough to pay for it.
No.
So they got to tax everybody. And let's say you do one of those people, unfortunate people that make $150,000 a year, you and your spouse. That's not that, 75 apiece, something like that, right? Do you still feel rich? I bet you don't feel rich. Yet that is a big amount. Those people that make like 150 and other, they pay most of the taxes. It's most of the federal income tax.
You got to tax everybody. And let's take it down to politics because you hear about it all the time. You've got Hillary Clinton that has $350,000 a couple dinners, right, that Clooney's holding for. Yet you've got Bernie Sanders that has his supporters giving him, $12 per person.
Right.
Who's got more money right now? Sanders at $12 per person.
Right.
So I relate the Hillary Clinton $350,000 dinners to taxing the rich,
Right.
and the $12 a person Bernie Sanders with the more money taxing everyone equally.
Right. And I get some of the points of view. Would this be free? I'd like this stuff to be free too. But you can't tell me I'm not paying my fair share when half of every dollar I've made for years goes to the government. Half of it. I pay double for Medicare, and I don't get any extra Medicare. I don't get like a Medicare Platinum plan when I get 65.
That's right.
I get the exact same one as everybody that pays nothing into it hardly.
That's right.
It's just like Social Security. I pay a lot more than most people. I don't get. Somebody makes a lot less than me, gets almost the same Social Security as I do, because you only get $1 for every $5 in benefit over a certain amount. And I'm okay with this. That's my problem. I'm okay with this. But when somebody tells me I got to pay so much more, that's when it starts to irritate me. Now, what does that have to do with your investments? What it has to do with your investments is Democrats, I haven't heard one plan that wasn't raising taxes. So it might be a good idea to get some tax preferable vehicles right now.
Absolutely.
And every poll is showing, I don't know, I know the one side says those polls can't be trusted. I get all that. But every poll tells you that Democrats could win everything, right? And not one of them doesn't want to raise your taxes. And if they get the House and the Senate, they're probably going to raise your taxes.
And we always say prepare for the worst and expect the best. So even if you prepare for tax-favored investments,
That's right.
and a Democrat doesn't get in, you're still in better shape.
Right. And so here's another point. Let's say you believe the Republicans are going to win. There's no way they're not going to win because blah, 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 whatever. And they're talking about reducing taxes. I haven't heard one of them that wasn't going to reduce
or a flat
taxes.
tax or what have you.
But I also haven't heard one of them that's not going to mess with Social Security.
That's right.
Extend the age, reduce benefit, means test, something like that. What does that mean? I need to have a little more money when I retire. Either way, putting more money in some kind of tax preferable vehicle like municipal bonds, like Roth IRA if you got some Roths, right? Also annuities. All of those kind of things are going to make sense. Every time I get more turmoil in the world or more people. Now, are one of these things going to help me out, by the way? I guess increasing Social Security could. The Democrats talking about increasing Social Security.
Maybe.
But it's going to be a means-tested thing. So, no. You made too much. It doesn't matter what you put in.
Give you an extra $100 a month in Social Security,
That's right.
and they'll tax you an extra $100,000 a year.
That's right.
Okay.
We've got the limit at 118. We're going to uncap that thing. Because remember, they did it to Medicare a few years ago.
That's right.
It used to have the same caps as Social Security. They just uncapped it. And now a lot of people pay much more in Medicare than they do in Social Security. And they don't get any more benefit. Now, if they gave me more benefit, but, I'm griping about Social Security. But to tell the truth, if you take the money you've actually put in it over 30, 40 years and what their benefit they're giving you, it's actually tough to duplicate. Everybody says if we privatize it and we got all this stuff, now I'm pretty hardcore right. But the truth is, most people didn't put in anywhere near what that income. You're getting $2,000, $3,000 a month. You might have only put in a couple $100,000 total. And so that's a big deal getting that other one. Well, that's our show, folks. I want to thank everybody for listening today. Remember, don't hesitate to call us if you have any financial questions or you'd like to take advantage of our no-cost, no-obligation retirement plan stress test and Social Security Optimizer. Our number is 972-715-2424 or go to ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always, always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.